pure white to help me color grade when the time is right. Let's be real here, right? Everybody loves crypto to a certain extent. Some people don't trust it. Some people think it's a scam. Some people believe that it's the end of the monetary system as we know it. Other people think of it as the mark of the beast. You know, one of those things that's just gonna come in and it's gonna tie us to whatever government we're gonna be facing in the next 5, 10, 15 years. And you're not gonna be able to buy or sell without it. There might be like a Fed cryptocurrency coming or something of that nature. But one thing we do know, and I think is probably guaranteed, I'm not gonna say guaranteed, nothing is guaranteed, right? But something that's gonna happen within the next 15 to 25 months. Bitcoin will hit $100,000 and probably maintain that price. For some of you, that's gonna be a signal for elation. You're gonna be joyful and you're gonna be making a killing. If you went into Bitcoin early, you're gonna be very happy about that. I should technically be happy about that. I'm one of those individuals that bought Bitcoin when nobody even heard about it, when it was less than $300, when it was just a weird obsession with computer nerds, trying to understand Federal Reserve policy and how money really works. Hanging around on the dark web, trying to figure out this whole thing, trying to figure out cash, money, etc. But in reality, my thinking is Bitcoin hitting $100,000 and greater, as a matter of fact. Well, that really signals that some things have gone awry. And in particular, that Bitcoin in of itself is not in a place where it needs to be. What am I talking about? I'm going to explain it in this video. So like, subscribe, click the notification bell. I'm Derek West, you're watching Finance Squared. Let's not dawdle, shall we? Like I mentioned, Bitcoin is on the verge of hitting a massive milestone, $100,000 per token. This is going to be thrilling news for many, particularly early investors like myself. If you were there in the early days where basically to get any Bitcoin, you had to mine it, you had to get it off of somebody else, you had to create your own wallet manually with hash keys, etc. You know, it was sort of the Wild West. It was sort of new, it was cool, it was techie, it was just free-spirited, interesting environment to be in. I don't think anybody really expected it to hit the heights that it hit today way back when. I think we all would have been happy if Bitcoin hit $1,000 per token and kind of maintained that. Bitcoin hitting $100,000 per token, which it's almost inevitable to do. Yeah, nothing is inevitable, nothing is guaranteed. There's always something that could happen that could make Bitcoin not keep on the trajectory that it's on today. And to be clear, that trajectory is up and down, as Bitcoin is very volatile. But the long-term trajectory, if you take a look at the chart over the course of Bitcoin's price history, you'll see that it's generally on the up and up. And eventually, my prediction is in under 2 years, and we're now in August of 2024, Bitcoin will hit $100,000 per token. But is that good for Bitcoin in the long term? My thinking is no, and here's a couple of reasons why. When Bitcoin first started off, it really was starting off as an alternative to your standard US dollar or fiat currency in general. The argument with fiat currency is it's really not backed by anything except for the whims of Federal Reserve chairmen, central bankers, banks in general, and that one of the things that we need as a society is a way to have the pricing of our dollars, the pricing of our money, separated from political and banking / corporate interests. It's sort of hard to fathom why you want to have your money separated from corporate interests, but that's sort of the idea. You want your money to be linked to something solid, something that's foundational, something that is useful, right? And that was one of the premises for Bitcoin. There's only going to be ever a set number of Bitcoins ever created, tokens ever created, and that's going to have to drive the price up and up and up, theoretically. The only problem with that, I believe, is that Bitcoin is eventually just going to become, or is going to be thought of by people that are currently investing in Bitcoin as a store of value. Ideally, that would not be a problem, right? Or why is that a problem? When Bitcoin is primarily used as a store of value, people that hold Bitcoin are less likely to use it for transactions. In other words, they're going to hold on to their Bitcoin and try to acquire new Bitcoin with the anticipation that it's going to rise in value, rather than spending it on items, goods, and services. Now, this hoarding behavior can help to drive the price of this token up, which is one of the reasons why I think that it's going to hit $100,000 eventually. But ultimately, as Bitcoin is a currency meaning a mode of transportation, a mode of transfer of value from one individual to the next, kind of like current in a wire. If that currency or that current is stagnant, just stuck in a battery somewhere, ultimately it's not providing value to anybody or any user. Batteries are most useful when they're powering an electronic device, when they're sending their current through a wire or through some mechanism embedded in the electronics of the application that it's in. Batteries are most useful when they're moving their current from one area to the next, helping to motivate and to move some piece of technology, whether it's an electric car, computer, smartphone, server, etc. If that electricity just sits in the battery somewhere and just stays there, it's not really being useful to anybody. And ultimately, that electricity is going to dissipate. It's the same concept with Bitcoin. Bitcoin sitting in a billion batteries and a billion crypto wallets, not really helping anybody. Taking us to the second reason, which is similar to the first. It's going to decrease the velocity and the circulation rate of individual tokens. Currency velocity, it's a very similar concept to what I just talked about, right? It refers to how quickly money moves through an economy. And most economists agree, for currency to be effective, it needs to circulate actively. And as Bitcoin's price rises ever higher, approaching this magical $100,000 level, its velocity is going to remain pretty low. And like we've been talking about, they're going to hold on to their Bitcoin instead of using it for everyday transactions, ultimately reducing Bitcoin's practicality and really, in the final sense of it, limit its adoption as a global currency, a currency used by many people for many transactions. And this third reason ties into everything else. It's going to encourage speculation on Bitcoin. Kind of like this video, right? But high prices attract attention, and Bitcoin hitting $100,000, approaching $100,000. Well, that's going to increase and cause a surge in speculative investments. Also actually causing the price to rise, but also causing people to bet that the price will fall, and not be wrong either. But speculators, they're going to buy Bitcoin not for its utility, but to profit from its price increases. And again, it's going to lead to extreme volatility and market manipulation, things that tend to happen around cryptocurrencies nowadays, but all kinds of markets in general. In reality, that's not what Bitcoin is for, right? Bitcoin is supposed to be a currency that people use to provide goods and services to each other that is an alternative to fiat currency. And it hitting higher and higher price points is just going to limit its utility in that regard. If Bitcoin continues to be seen as primarily a store of value, it's going to lead to people looking for alternative currencies, alternative crypto tokens. And that's really been the trend, right? As the price of Bitcoin rises, other cryptocurrencies that are in the space are looking to take the place of Bitcoin as an actual means of conveyance. I like to talk about the three phases of cryptocurrency, as I see it, right? There's the first wave, Bitcoin, Dogecoin, etc. Really depreciating currencies, Bitcoin, Litecoin, a couple of the others in that era. Dogecoin falls into that, but sort of a different kind of space. But cryptocurrencies that really establish blockchain's first use case as a means of currency. That's sort of the second wave, building upon the first wave and providing use cases for broader blockchain adoption. Ultimately, the third wave is coming around, and that's what the wave that we're in right now, where we're really thinking about the best ways to implement and to iterate through cryptocurrencies and what is the best place for them. And in my mind, we're going to hit a point where there's going to be a cryptocurrency that comes along, a crypto token, that will eventually knock Bitcoin off its perch as the most utilized cryptocurrency. Right now, Bitcoin is almost synonymous in the mind's eye of many passive investors. Bitcoin is synonymous with cryptocurrency, but eventually, as it becomes more of a store of value, causing it to become less of a utility in the eyes of those that use crypto, it's going to be replaced by a cryptocurrency. Again, not a prediction, but in my mind, a very likely scenario. It's going to be replaced by a cryptocurrency that is going to have a lot better value proposition and can also be seen as a currency and not just a store of value. One such token that I think you might want to check out is AO. I think it has the opportunity to both be a utility token that can power our technological future, AI, quantum computing, etc., while at the same time being a conveyance for trading goods and services. I'm putting together a video on that right now. So be sure to like and subscribe so that you get that video when it drops. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'm Derek West. You're watching Finance Squared. I'll catch you guys in the next video. Peace.